Why don't prices matter? And if they don't matter, what should our viewers be really watching when it comes to the markets?
Good morning, Brian. Well, it's not that prices don't matter. It's just that generally, I think the public, when we look at what the market's doing, you see the price of the Dow Jones or the S&P or the NASDAQ, and I think people can get fixated on the price level of an index. But the price is just the price. It's really the value proposition that matters, and that's a fancy way of saying that the PE is what matters, right? The valuation is what matters. So what are we as investors willing to pay for each dollar of earnings is a more important metric than just whatever happens to be the price of the index at the time. So the index could be high but trading at a low multiple, and therefore it's cheap, or it could be low but trading at a high multiple, and therefore it's expensive. So that's really all I meant to say, was that it's the valuation that matters. And the valuation is driven, as it always is, by the fundamentals of earnings, free cash flow, margins, et cetera, the sustainability of those earnings, and then the interest rate environment or the liquidity environment where, of course, the Fed plays a large role. And what has happened, obviously in recent weeks with the trade tensions sort of escalating again, is that both of those pieces of the puzzle are back in play. Earnings growth was booming last year. It's slowing this year. We may get negative growth in the second quarter, although that's what they said about the first quarter, and it turned out to be okay. And now, with the curve kind of near inverting again, and the fears of a prolonged trade war, the Fed is kind of getting back into or not into the game, but the notion of Fed cuts is getting back into play. And so then you have both of these pieces of the puzzle in a state of flux, and PE, the PE is the transmission mechanism for uncertainty, right? And we have more uncertainty now than we thought we did 2 weeks ago, and as a result, the PE has to come down, which is what it's been doing so far over the last 2 weeks.
I hear what you're saying too, but I feel like prices are the score. You can analyze the game all you want. Well, their running back had this more many yards, and their quarterback was this better, but if it's 38-34, we know who won. I think that's why we look at prices. They're an easy scoreboard. But inside the game, how do the markets look from a price to cash flow, or price to earnings, or price to sales metric?
Well, I mean, that is the big question, right? So as you point out correctly, price is price, right? I mean, there's only one price, and that's the price. At PE, you have to start worrying about, okay, trailing earnings, forward earnings, how good are the forward earnings? Are they going to change? So the PE is always a moving target. And so, in all fairness, obviously price is what we look at, and there's a good reason for that. But this is where you start kind of gaming this whole trade situation, and who are the winners and the losers if we do have a protracted trade escalation going on. And actually, it kind of reminds me a little bit of this whole prolonged Brexit drama. The UK referendum on Brexit was almost 3 years ago in June of 2016. And if you look at what's happened to that market since then, obviously we've had this nonstop drama of this ongoing soap opera of whether or not they will do it and how. And then you always have this tail risk of a hard Brexit sort of lurking in the wings. And the trade story kind of feels the same way. So if you look at what happened in the UK, the stock market actually did all right. Earnings are actually up 30% since June of 16. So the earnings story has been fine. But look at what happened to the PE. It went from 16 times earnings to 11 times earnings over 3 years. And that was, in my opinion, that's really where you can see the damage in the UK, that investors are like, why am I paying 16 times for a pound of earnings when I don't really know what the future holds? And I think that is the risk in the US. It's not my default scenario, but at a 17 times forward multiple in the US, a lot of things need to go right. And if they don't, maybe it's 15 or 16 or even 14 times, and that becomes the question. And for on the tariff side, if tariffs are a form of tax, and they are either a tax on the consumer because they're going to pay more for their goods, or it's a tax on corporations because it erodes their profit margin, even U.S. companies, this is not just about Chinese companies, of course, then again, it kind of starts to hurt the whole cash flow argument, and again, that might justify a lower PE. So I think that's kind of ground zero here for the markets, I think.